If you've been trading stocks for a little while and now you're hearing about trading options, you might be wondering, is trading options actually better than trading stocks? So I'll share with you some insight in this episode. All right, so if you really look and evaluate just the concept of trading stocks or investing in the stock market, there's kind of basically one or two ways that you're making money in the stock market. Number one, you're either making it from appreciation or depreciation if you're shorting things, and then from dividends. So in other words, if we take a look at this diagram, you're basically making moves or income from when a stock goes up like a rocket or it goes up slightly. So this is, a stock can also go sideways, it can go down slightly, or go down like an elevator, which is kind of toast. So if you're buying long, you're basically making money this way. If you're going short, you're making money this way. But in general, let's just say, okay, if I'm buying stock, most people are looking for upside appreciation. So they're looking for an upside move. And if it kind of moves sideways or down or against them, they're usually not making kind of money. It's got to have some kind of movement. Now, if you're short, okay, if you're short, which if you don't know, you're selling, let's say 100 shares before you're buying and then you buy it back later, yeah, you could make money this way as well. But once it's going short, it's already starting to, make money on the downside. But if you're long and it's going against you, you're losing money. So the issue is you need movement, and you need movement in your direction for you to make money when it comes to stocks. In the option world, it's quite a bit different. So in the option world, what you could do is you could set up things called spreads or situations like this. So this is a risk profile picture if you've never seen it. This over here is my profit or loss, and here's the zero line. This is the stock price, okay, down here. So the current stock price is right there with this dotted line. So this green line is the expiration line. This white line is today. So what happens is this white line forms closer to the green line. And with time, I make money. So here's our theta, or the time. Basically, I make about $10 a day from that line going higher and higher. And you can also make money from vega. You can make money from the delta, which is your price. And those are kind of the main ways. So you've got a couple of different ways. But what you could do is create spreads or these different situations where you can make money in many different ways, depending on how you see the stock position. So if you look at just buying the stock itself and buying it outright, if I buy 500 shares of Costco, the only way to make money from this is either A, dividends if they have any, or B, it's got to go up, and it's got to go up in my favor. If you're dealing with an option spread, what you could do is set up spreads like, just to give you an example, let's say a vertical. I could go out 18 days. Here's the call side, here's the put side. And then what you can do is, let's say I sell an option spread. Okay, so I sell one and then I buy one. Okay, so this will create a vertical spread. And what this does is it basically allows me to make money from this stock sitting at 450, or it can pull back to this price level, or it can go up. Okay, so it can pull back to 430. As long as it's above 430, I make my premium. So how much am I making? In this position, I'm making $48 on 452. So 452, you're making 48. So when you look at this, it's, around 10% of capital in 18 days. Now, is this going to pan out all the time? No, because out of, let's say, 50 trades, you might have 30 winners, you might have 20 losers. So it varies. You're looking at a spread, a range of trades, not just a single individual trade. So when you're looking at these kinds of situations, what you can do is you can create all kinds of different setups where some are benefiting from, you can see this one is from an upside move. You could also set up a trade where, hey, I could do one here and I could do some spreads over here where I'm also making money from the downside. And now I've got this thing called an iron condor. So making money from this side, I want the stock to go up. This side, I want the stock to go down. So as long as it kind of stays in the middle between this goalpost, you're making about $3 a day. Here you're looking to make about $65 on about 410, I believe, of capital. So it's, 435, and you're trying to make about 65 at expiration. Now, can you get out of it early? Yeah, of course. You don't have to wait till expiration. So what you could do, and just to show you different examples here, I'll go and show you, let's say here's Boeing. Here's some trades. You can see this one is directionally based, but as long as that stock stays down and below that price level, okay, currently we're up $31 on this, and as long as it's below this price level, so it can go down, it can go down a lot, it can go up on me, it can go up quite a bit, but it can't explode too far. So this is kind of my line in the sand. Okay, so there's Boeing. CMG, you can see this one is more of an iron condor. So this one, it's got to stay kind of between the goalposts here. So it can go up or down, it can wiggle in this range, but it can't move kind of beyond that. If it does, then I could start losing money, and that's where I would lose maybe $86. But if it kind of goes up on me, I'd make only $179. Currently, we're up $257. Let's do a couple more here. Let's check some out here at a different place, NVIDIA or Piton. Let's see. Okay, so you can see this one is a spread. That's a calendar spread. This spread is actually at a loss. So this is how you could lose money on these spreads. And you can see this one is pulling back on me. So this NVIDIA, I'm looking to be a little bit bullish on it. I've got 24 delta, just kind of like having 24 shares of stock. Okay, I'm making about $2 a day from time, but I kind of need it to go in this range, in this tent. So it's a whole different ball game. As long as it kind of gets into that tent before expiration, I should be okay. Let's take a look at Boeing in that example. This is a little bit of a different spread. So here I have some verticals that are bullish like this, also looking for a directional bet, and then I also have some that I'm selling that are bullish in this this way, where you're making a little bit of time. So you can see there's a lot of flexibility to those spreads, and I would say I'm biased in the sense of, hey, I enjoy trading options much more so than stock, because you get a lot more flexibility and you can allocate a little bit of capital here, here, all over the place. However, they are more complex. So this is the huge downside with trading options, is that it takes a lot more understanding of how these behave and work before you can kind of do them, because if you're doing them incorrectly, you might not even know how to put on the trade. You might not understand how the trade works or behaves. So there's a lot more knowledge to kind of get started in it, rather than with a stock. People understand, hey, I buy something at, let's say, $50, then I get out of it for $75, then I'm good. So you basically, you buy a teddy bear for, let's say, $10, and then you go across the street and you sell it for $15. Well, you just made $5 in profit. Options are a little bit more tricky, but in the same sense of you're buying stuff and you're selling stuff. And the difference between your buying and selling is your profit. So it's no different. It's just you have puts and calls, which have different obligations and a little bit of problems with it, because you're dealing with some time premium and volatility and some other factors that you can work for you or against you. So that makes it more complex, but I do think they give you the flexibility. Are they necessarily better? It depends. Are you looking to be a little more active? Then option trading may be for you. Are you okay with studying a lot more and learning a more difficult subject? Then yeah, trading options might be more for you. If you want things as a simple approach, like super simple, hey, I don't really want to learn that much more, then just go in and buy the stock, or even you could buy just the ETF itself. So you buy the ETF and just hold on to it and let things appreciate. Buy more on the dips and let them again appreciate with time, or whatever, as they continue to progress and get the dividends. So you don't have to get into option trading, but it gives you more flexibility, more versions and variations of ways you can make money, not just from appreciation, but from time decay and volatility, and from price movement. So there's many other ways that you can make money from option trading. But it does require more work, study time, and it can be a little more complex for some people. So it just depends on the type of person that you are. So are they better? There's trade-offs to both. So anyways, I hope that answers some of your questions. Thanks for joining me in this video. Feel free to grab some freebies at our website, where you can just download some PDFs, cheat sheets, mini courses, and much more. Hope to see you there. Thanks again, and I'll see you next time.